up, buddy?
Hey, how's it going?
Good. How are you?
Good. It's been a long time since we've done this, and I'm very happy.
Yeah.
Very happy. I'm happy to be sitting here. Happy to be sitting here with you and producer Matt. Happy to be in a nice jacket. I'm just happy.
Yeah, you look handsome.
Thank you. Thank you. Thank you. So tell us what's going on today, because I'm really interested. You told me a little bit about what's going on, and I've been holding back my questions. So tell us.
Okay, so today is the 18th of May. It is end of the day. If you were watching the stock market today, it took an absolute beating. And it kind of had a bit of a bounce yesterday. Today it did not bounce. It dropped like a stone. And there's a lot of reasons for what's going on in the market right now. The main reason is that the Federal Reserve and the central banks around the world, more specifically kind of like the G7 nations, have all decided to start very heavily combating inflation and telegraphing to the market that they're going to increase interest rates. We've already seen interest rates increase. In Canada, we just saw a 50 basis point hike in April. So let's speak kind of Canada specific right now. The Bank of Canada is telling us that inflation numbers are still running really, really hot, and everybody can see that now, right? Like we can feel that gas. Like I filled up gas today. It was like $2.50 a liter.
For premium.
Yeah, but still, it's expensive. I don't know. I don't even pay attention to what gas costs. And today I was like, oh my God, like that's expensive.
Yeah, I feel you.
The share of wallet for disposable income of Canadians is being eroded at such a fast pace. And there is so much kind of uncertainty for Canadians right now, and kind of people everywhere. Where does this go, right? Like where are we going from here? I think the biggest thing affecting the Canadian market, and you're looking to us, we're a mortgage brokerage and a mortgage lender. So you're looking for us to kind of provide you with some input on how this is going to affect housing prices. Well, the uncertainty of how much interest rates are going to rise, as dictated by the Bank of Canada, is leading to a lot more cautious behavior in the real estate market. From what I was reading today and what I've been reading over the last couple months, the Canadian real estate buyers are not showing up as they once were.
Right.
And there are some numbers that reflect that. Like there's something called there's a ratio of sales to new listings. And over the last year, like kind of April to April, that number was hovering in Canada at about like 76%, meaning 76% of the new listings that came up sold.
Right.
Like this is the ratio. That number has now dropped to the 60s. More specifically in Toronto, it's dropped to 45%. That typically is a leading indicator for housing prices. So It tells us that housing prices are going to come off. And I think that the reason why we're seeing that is because the Canadian consumer is saying like, geez, how can I plan to buy something right now when I don't know just how dramatically interest rates are going to increase? So let's maybe start with that point. Because we've been talking a lot about how much we think we're going to see interest rates increase.
Right.
So the deputy governor of the Bank of Canada spoke as recently as yesterday about this very topic. And the governor of the Bank of Canada spoke about it when they did their monetary policy report in April, and they hiked rates 50 basis points. And it appears as though the Bank of Canada is telling us that the neutral range for the overnight rate, the target rate for the Bank of Canada, which is now at 1%, the neutral rate for that they want to see is they want to bring it up to between 2 and 3%. Historically, that's been 2%. Now they're saying that it may need to be adjusted higher to account for inflation. That means that it's another 100 basis points from where we are right now to get to 2%. And that will affect the prime rate directly, right? So prime rate's at 3.2% right now. We can expect to see, at a minimum, another 1 percentage point added onto prime. So look at a prime rate of 4.2%, possibly higher. The reason why it may have to be higher, what the Bank of Canada is telling us, is that the ability of the Canadian consumer to withstand increasing interest rates may have increased because Canadians have saved more,
right,
and mortgage debt has slightly decreased. I disagree. I think that what we're starting to find out, what we're going to find out, is that the ability for the Canadian consumer to withstand another 1 percentage point increase in rates is going to be just as dramatic as we thought it was pre-pandemic, and it will definitely affect housing prices far more dramatically.
Yeah, I mean, it already started.
Yes. So I think, kind of if you're looking for the Coles notes of this, you don't want to rush into a fixed rate right now. You want to, if you need to go into a product, you want to go variable.
Right.
And I think that as we look at this trajectory of increasing interest rates, we're going to see flashing recession signs become more and more clear. Like there's this argument still in the States relative to the American economy. Like, are we going into a recession? Are we in a bear market? I mean, today the NASDAQ dropped 5%, right? The S&P, I think, dropped like 3.5%. So like what we're seeing is like, hey, we're going into a recession. We're going into a bear market. We're here.
Like 2011 recession. It was 2011.
I mean, I don't know what to compare it to. It's difficult for me to tell you the kind of depth that we'll go into of a recession. You keep hearing these quotes like we're threading a needle with our monetary policy. Like the Federal Reserve is threading a needle because they have to fight inflation, which is running super hot still, like 6% higher, 6.5% higher for Canada in April of this year versus April of last year. These are big readings. These are big numbers. And inflation is a really scary thing, especially, I don't know if you remember, we spoke about this like maybe 4 months ago. We were talking about what happens when you have inflation and you have slowing economic growth and increasing employment. It's called stagflation.
Right.
It's the worst thing that can happen to your economy. And I like threading a needle is a really delicate way to say like there's a really good chance we're going to screw this up.
Right. And is this Canada only, or is
I'm talking about like the world?
Yeah,
right?
yeah.
I'm talking about like the United States. Canadian economy is like a pimple on the United States economy.
Yeah.
Although we'll benefit from some of the resources and the energy production that we will hopefully the energy production we got to bring online still. We got to do more to kind of stimulate that. We spoke about that in a previous podcast. I would say I'm just a little bit stressed today. I don't know if you can tell. I'm a little bit stressed.
Yeah. I'm not gonna lie. When you open the podcast, I've seen like Armageddon. When the newscaster gets on the TV and he's like, ladies and gentlemen, like I'm signing off.
Yeah.
Like it was one of those. So I can tell you're stressed.
Yeah. Okay. So I'm stressed. I'm stressed because I hate, I don't like dramatic moves, right? I don't think like very dramatic moves in an economy are healthy. And the reason, what stresses me out is like we have so many of our borrowers and our investors who are also invested and subject to the stock market, right? I don't worry about our mortgage fund.
Yeah, definitely.
Because I know the way we lend money, and I know the borrowers that we lend money to, and I know how conservative we are on our loan to values. And to put it in perspective, right? Like if the market in the last 24 hours dropped 5%, you're looking at a NASDAQ that dropped 5%. That level of erosion of people's savings and investments is a scary thing.
Yeah.
Right? People who were told like jump into this with your eyes closed and buy this stuff and get a mutual fund, who really weren't getting like all of the upside associated with like how this market was moving, because they were getting feed by management fees and origination fees for the products that they were buying, are now going to get all of the downside.
Yeah.
And if you've got your retirement savings in the stock market and you're watching it drop 5% in a single day, that's a scary thing.
Yeah.
And everyone's kind of saying like, well, what's the bottom? Where does this go? Listen, like March of 2020, the S&P was at 2,600. Today, when it closed, I think we were at like 3,900.
Right.
At its peak, I think we reached 4,500. And I'm not saying it's going to go back down to 2,600, but I'm saying that like, it's got a higher probability of going lower from here than it does from going higher.
Right.
And the only thing that typically and historically has changed that, the thing that has kind of led to our bull market in everything, has been a really accommodative Federal Reserve and central banking system around the world, right? Federal Reserve is what we call like the parallel entity of the Bank of Canada. It's called the Federal Reserve in the United States.
Yeah.
So, I mean, I love that the Fed and like the governor of the Bank of Canada, the governor of the Bank of Canada, believe that, the governor of the Bank of Canada is saying the Canadian consumer is strong, the economy is strong, it's overheating, we're going to increase interest rates, we got to slow things down. But our economy is so heavily based on our housing market that things will move very dramatically and very quickly if we are not keenly aware of how much another 1 point or 1.5% or 2% at the most is what they're talking about, neutral policy rate of 3%, how much that's going to just shake the confidence of the Canadian consumer, of the Canadian real estate buyer, of the Canadian real estate investor. So I still really think that we're going to see another 1 point increase, and then we're going to feel the negative impact of that increase, and we're going to see rates come back down again. I think that inflation is something that, like, we've spoken about all this stuff. Matt, I don't know which podcasts they were. You should maybe somehow find a way to like put it up on the screen or something after the fact. The reason why it's happening, like the reason why Joe Biden is talking about inflation in the United States, is because people are feeling inflation, right? People are feeling it. But this inflation is being caused by people within the supply chain increasing profitability. It's being caused by certain disruptions today. And I don't believe that an increase in the overnight rate or rapid increases of the overnight rate will remedy that. And I do like the idea of waiting a period of time, like, 4 to 6 months, to see if these things work themselves out, as the Bank of Canada is predicting. Right. The other thing you got to keep in mind is we're citing this rapid runaway inflation on this basket of goods, but it's a year-over-year calculation. So we're calculating an increase over the previous year, and the previous year was abysmal.
Yeah.
Right. So to see another year-over-year increase would be alarming because we saw such rapid growth. But on a year-over-year basis, you should expect that we were going to see a rapid increase. It's the continuation of it that would be more concerning. But what we spoke about was inflation is measured as a year-over-year number.
Mm-hmm.
When you have a year of really, really high inflation, once that comes off, which it's starting to come off now because we've had high inflation for the past, 9, 10 months, your year-over-year readings will now start to look more muted and may not require the same kind of very aggressive tightening that we're seeing.
Mm-hmm.
So maybe we won't see a 2 percentage point increase in the overnight rate, which would take our prime rate to 5.2%. Maybe we'll see only a 1 point increase. Maybe that 1 point increase brings us to 4.2%. But you're seeing the markets, which are another leading indicator of the economy. You're seeing the markets, like when the market drops 5% in a day, it's telling you, like, we don't see a lot of good stuff in the future,
a problem.
right?
There's a
the
problem.
markets trade on something called, like, what everybody monitors is a price to earnings ratio, right? So they, like there's either a kind of lofty price to earnings ratio or a neutral price to earnings ratio. The price being the price of a stock,
Mm-hmm.
and the earnings being how much that company, that stock earns.
Right.
What is happening is when money was cheap and when money was free and it was just getting pumped into the system over the last 2 years, the price relative to the earnings of companies became high.
Right.
Because people had money and they needed to find places to deploy that money. And when they did that, they kind of all rushed to put money into these companies.
Right.
Well, supply versus demand, the demand increased, so the price increased of those companies relative to their earnings.
Right.
So everyone cites the price to earnings ratio of these companies. And now we've seen the price to earnings ratio fall because the prices fell,
Mm-hmm.
because consumers are becoming concerned, right? Investors are becoming concerned. A recession will reduce the earnings of those same companies. So we'll see the earnings drop. So even if the price to earnings ratio stays the same, the earnings will drop, which means the stock prices will fall further. Right? You see what I mean?
Yeah. Absolutely.
And there are some aspects of human behavior that are affected by, like the psychology of the market and how rich people think they are and how much money they're spending and how many times they're going out for dinner is affected when they look at the stock market,
Mm-hmm.
right? Like it's almost become like this social barometer. It's like Trump started touting the stock market as like, look how good the stock market is. That's how good I'm doing as a president.
Yeah.
Right. Believe it or not, though, like the more the stock market kind of gained steam, and let's just use the S&P, right? S&P at 4,500, people were spending money and they were, freewheeling and fancy free.
Mm-hmm.
Seeing that S&P or any of these indexes kind of continually get dropped and eroded is going to tighten people up.
Right.
And it's going to reduce consumer spending. It's going to reduce consumer confidence. It starts there. It trickles through. So we're combating inflation because people are worried about prices increasing. Prices are increasing because energy costs are increasing. Supply costs are increasing. There's been disruptions. We've been talking about all this stuff. All of these are going to further erode consumer confidence. And we're being told by the Federal Reserve, being told by the central banks that, hey, this is necessary.
Right.
We need to get inflation under control. Primary concern, inflation. And we hope targeting inflation doesn't lead to a recession, but we're targeting inflation.
Right.
They've told us that. I read another article today, a guy named David Rosenberg, who's like a perma-bear economist, who said in the last 8 years, all we've heard people say is don't fight the Fed. The Fed wants to stimulate the economy. The Fed is decreasing interest rates. The Fed is spending money. The Fed is printing money. The Fed is buying The Fed was buying stocks at a certain point, but debt, they're buying all kinds of things. Don't fight the Fed. The market's going to go up. Don't fight the Fed. No, don't bet against them.
Right.
Regardless of the fundamentals of the economy, don't fight the Fed. Go along for the ride.
Right.
Well, now the Fed is saying markets be damned, recession be damned, essentially. Not like, listen, trust me, if we go into a recession, we're going to see accommodative policy come through. We're going to see rates come back down. But for the most part, we're hearing markets be damned. Our biggest concern right now is inflation, and we need to increase interest rates, and we need to be less accommodative.
Right.
That has got to be worrisome. Sorry, what are you going to say?
Well, I was going to say, I think we're overdue for a commercial. Let's go to commercial. Let's maybe put up an old video of us, and we'll be back, and we'll talk a little bit more about mortgages in the market.
Sure.
Toronto, defined by its people. Hardworking, dependable, generous, accepting, beautiful. People who need help sometimes. But when we need help the most, our banks say no. Cannect helps homeowners borrow for less. Not just today, but forever. Your home loan approved online in seconds. Funded in 24 hours. Then, unbiased lending advice to get you back on track, the way it should be. I'm Marcus from Cannect. Let's make money count.
Hey guys, welcome back. We're back.
I wish I was a little more jolly about things, but
It's
honestly,
a bit sad today.
Listen,
okay.
sometimes, we got to address what's going on in the marketplace, right?
Yeah.
So if you're at home and you're watching this right now and you're thinking to yourself, oh my God, things sound like they're really not going to be great. I can tell you, if you have a bunch of debt that's at high interest rates, credit card, this is the most immediate thing that I can think of to offer as advice. If you've got credit cards that are weighing on you, line of credit, car loans, you go to Connect's website. It's the only tool like it in Canada. You enter in your address. We can tell you how much money you can borrow and how cheaply you can borrow it. It's always unbiased. It's always whatever the lowest available rate for you is that we can find. You always get paired up with a salaried mortgage agent from Cannect that's going to advise you as to how to best borrow money for your particular situation. It all starts online at connect.ca. It is super easy. It is super customer focused. And the sooner you look to do something like this in a market like this, the higher the value you're going to get on your home. Mm-hmm. And the sooner you'll start saving money on interest rate, on whatever the rate difference is, on whatever you were paying on a credit card or on a high interest rate loan or on a high interest rate mortgage, and the product that we're going to put you into. So there's never been a better time. I know we always say that. If you are looking for money, when interest rates increase, property values come down. It's very typical, right? The larger the anticipated increase in interest rate, the greater the uncertainty in the marketplace, the more property values will decrease. Mm-hmm. If your property value is important to the amount that you are looking to borrow, which in many cases it is,
100%,
right? Then the sooner you look at doing it, the better. And again, it's like you go to Connect, it's non-committal, right? Like you can go to Connect, we don't have to check your credit. We can have a conversation. We can give you the advice, and you can take what you want from it.
So I got a couple questions here from some loyal viewers.
Sure.
Are you ready? For my first question, taking the viewers away, what should I, Justin Turner, do with my stocks today? Riddle me that.
Okay. Well, I mean, it really depends. I kind of know what you own, right?
Yeah, it's already
talk
a
about it all the time. Listen, I think that you wait until you see days where the market's going to rise, and you try to sell some of it.
You plop it.
I think you not all of it. Like you try to. It depends on your conviction. Like I'll tell you something. Right now, I only own 2 stocks. going into this, I sold everything.
Right.
I have pretty big positions in the 2 stocks that I own, but the things that I own are things that I wasn't planning on selling.
Right. Yeah.
And does it hurt that like, I mean, one of them is gold. It's a gold mining company, and it's like, it hasn't really moved. It's kind of pretty stable. I might buy more of it.
Right.
The other one is a pharmaceutical, and they're developing something, and I am like, I believe in the company. I believe in what they're doing, but I probably wish that I sold it.
Yeah.
When it was more than twice what it is right now.
Yeah.
For sure. So if you have a thesis, like, I mean, it's hard to look back, right? But if you have a thesis as to why you bought something, stick to your thesis.
Right.
Right. But there's going to be some pain ahead, right?
Yeah.
Interest rates are going to go up, which means that it will cost more for people to hold assets, and people will need to, not everybody is prudently thinking about assets and how they're buying them. So they'll have to sell assets, and that's what's happening. And as assets get sold, they drop in price.
Yeah.
And there is a guy named Howard Marks who's like a famous fund manager, and he has this line. It's like, it's a pendulum, right? When the exuberance happens, when the greed is in the market, the pendulum swings too far in one place.
Mm-hmm.
And then when you tap the pendulum because something's going on, pendulum swings in the other direction.
Right.
It's going to swing too far in the other direction, and that'll be an opportunity to buy.
Yeah.
Well, that's what I was just about to ask you, Marcus. Do you see this like for people sitting on the sidelines, like you're now out of the stock game, for the lack of a better word? Do you see this as being like a buyer's opportunity in the future?
I don't buy into the stock market.
Well, I mean, for anybody else though.
Yeah. So like I'll tell you, Matt, the reason why I created the MIC
Yeah, I
is
know.
because
it's not a gamble, really.
The MIC makes 8%. Now, like last month, we were at 8.5%.
Mm-hmm.
The MIC sticks to conservative valuations on real estate. Like already our portfolio, when we go to value something, we're valuing it at 15% below market, right? Like we're built for this type of environment.
Yeah, I was gonna say the only thing that I haven't lost money on in the last little bit is the MIC.
Right.
Yeah.
Yeah. Listen, it is so easy to get carried away, right?
Mm-hmm.
Like when the sun is shining, you could convince somebody to bring their dining room table outside and have a nice dinner party and maybe bring their TV outside.
Sounds like a good time.
And it'll never rain.
Try to record a podcast outside.
But guess what? Guess what? Eventually, it's going to rain.
Yeah.
And your shit's going to get damaged. And this is a buddy of mine today I was speaking to. He's 82 years old. He's in Mykonos. We're talking on the phone. And he goes, well, when it's sunny, nobody thinks it's going to rain. And he's right? Like,
yeah.
I love these little anecdotal kind of pearls of wisdom that you get from people that have been around the block 82 times.
Yeah,
been around the block.
Yeah,
82 times.
100%.
So in managing the MIC and managing the money in the MIC, I can't tell you how many times in prospective investors call and they're like, wow, I wish it was 12% the return. Why isn't it higher? I'm going to pull my money out of the MIC because I'm going to go into the market because my friends are making more money in the stock market. Listen, the MIC is not a way to get rich quick.
Mm-hmm.
The MIC is a way to plot along slowly and get rich slowly.
Mm-hmm.
But for the MIC to drop 5%, I was thinking about this. For the MIC to drop 5% like the NASDAQ did today, you probably have to see real estate prices correct by 50%.
Right.
And all the people that borrowed money from the MIC would have to go bankrupt.
Right.
Right? 50% correction in real estate and every borrower goes bankrupt. That's what
It's
it
never
takes.
going to happen.
Right. So I don't know. What would I do, Matt? I don't think it's a buying opportunity yet. I don't think we felt fully the pain. I guess talking to another buddy of mine, like, one of my best friends who's a hedge fund manager. And he says, you know what? 5 or 10% more down. And then we start buying.
Is that Thanos?
No, that's not Thanos.
That's old school. That was like the origination of the podcast.
Yes.
All right. I got emails here. Can we get into some
Did
emails?
I fully answer your question, Matt? I wouldn't buy yet. Smart people that monitor the stock market are telling me that if it drops another 5 to 10%, they will start buying.
Yeah, like be scared and greedy, or greedy to be scared.
I keep thinking, I don't know why it's ingrained in my head. I keep thinking about an S&P at 2,600 when COVID hit.
Right.
And I don't know, could we test those lows again? 2,600 on the S&P. We're at, what are we close today at? 3,900, 3,900 probably. That's a little ways to go still.
It's a far drop.
But like a drop, anyways.
That's like
10, 10 points
30%?
off of here doesn't take us to 3,500 on the S&P.
Right. All right. I got some emails here. Let's get into them. So we have our friend Amy. So she says, "Hi, Justin and Marcus. My name is Amy. My mortgage is coming up for renewal within the next few months, and I'm worried that with the rates being so much higher than what they were when I first got my mortgage, I won't be able to afford my new monthly payments when the time comes to renew. I'm on a fixed income, so there is not much room for me to pay a significant amount more monthly, and I've been looking into some investments to try and to find new ways to generate some income, monthly income, but it's all confusing for me. I know you guys also deal with investments, so do you have any advice for me on that end?"
What would your advice be?
I mean,
you know what I'm going to say. What would your advice be?
Yeah. We're going to take a look at refinancing, pulling out some equity, borrowing at considerably lower than our MIC, and investing to offset her monthly expenses.
Yeah.
Yeah. It's a slam
subject to her being eligible to invest in the fund, and for her understanding the risk criteria of the fund.
Right.
Which, I don't know that there's ever been a better time to invest with Cannect than right now.
Right.
Right? Like, we've been cautious in how we've been lending over the last 2 years. As real estate prices started running up, we didn't rush to get our money out the door.
Yeah, no.
And you get a guarantee from me that, I've got $2 million behind any single one of our investors. So before I forget the name of the person that wrote you that email. Amy. Before Amy loses $1 of her investment, I got to lose $2 million.
Right.
Which I don't plan on doing.
Yeah, no.
Anyways, I definitely, we've got some clients who maybe listen, at the end, you don't know when this thing turns around. I just that we have some of our clients that are taking money out to invest in the stock market right now.
Mm-hmm.
Taking money out of their homes, taking money out of the MIC, and it's their money.
Yeah.
I am not intelligent enough. I do not monitor the market, the stock market enough to know when it will change course. And a lot of it has to do with the psychology of the market that I was telling you about. And when you see a drop as significant as what we've been seeing, that it tells you that the market's not seeing a lot of positive in the future.
Right.
We could see another bounce tomorrow. I hope we see another bounce tomorrow.
So do I.
And I hope that some other positive variable enters the market. Like, I hope that Putin gets out of the Ukraine.
Mm-hmm.
Yeah, that'd be positive. That would be lovely, right?
That would be positive.
I don't think it's going to happen, but that'd be something that'd be nice to see.
I've been seeing a lot of people talking about bringing the oil manufacturing back to Canada and how that would help the economy.
I mean, what episode did I say that? That our ignorance towards our energy policy has led to a cataclysmic failure in foreign policy. Matt,
I believe it was only 2 or 3 episodes ago.
Okay. So, yeah, you know what? Let's put our heads in the sand and assume that carbon offset credits and being great for the environment will not have an impact on how rogue nations begin to deal and treat other nations, including ours.
Mm-hmm. Mm-hmm.
We're already seeing it, case in point.
Yeah.
So don't worry. Now, as a complete knee-jerk reaction, same kind of pendulum bullshit that we were just talking about.
Yeah.
We're going to come right back now, and we're going to see more drilling and pipelines, and Qatar is building more inroads into Europe to supply more natural gas, more liquefied natural gas facilities at different ports in Europe to accept natural gas. Listen, fossil fuels aren't going away next week, right? Amazing. Listen, solar and wind and electric cars, all these things are so amazing. But you need to maintain a fossil fuel supply commensurate with how an economy is growing, right? Again, it's all supply and demand, right? If the demand for fossil fuels increases and the supply decreases, then the price is going to increase. So we can't sit around now and say like, okay, well, Russia, we're not buying your oil and natural gas. Prices have spiked. Demand looks like it's going to be strong. Oil was at $0 2 years ago.
Yeah, not too long.
It was at $0 a barrel.
Yeah.
People were buying oil. People were being paid to take barrels of oil. They didn't know what are we going to do with all this oil? Oil's done. But oil's over $100 now, right? This is all supply and demand. So like the idea that a future, listen, long term, as my buddy Evan Johnson says, mega trend, less oil. Thank God, right? Because we only have one planet, and I am not ignorant to the impact of fossil fuels on this one precious world that we have. But I'm also not ignorant to the supply and demand economics of how badly it affects an economy when you're not being proactive about the amount of supply of something you need as the demand increases.
So, Marcus, let me ask you then, do you believe, like, obviously they talk about there's no refinery plants here, so the solution is to spend infrastructure money to build that. But if mega trend, if oil's done, wouldn't the money be better spent on green energy projects?
You got to do both.
You got to do both.
You got to do both.
Okay.
It's like there's not one sound bite that works, which is why politicians can't solve the problem. You can't solve it in 4 years. It's not going to be popular right away with everybody. It's not like there's not some feel good, amazing story that solves these problems, right? It's a little bit of pain and it has to have long-term vision. And we are not doing that.
Right.
We had a whole bunch of money that we could spend I talked about this in a previous podcast. We had a whole bunch of money that we could spend to inject into our economy, and we had carte blanche to do it because of COVID. And what did we do? We basically just printed money and handed out checks in the most inefficient manner as possible. And we said, no, it has to go out fast. So it forgives our incompetence as to how we're spending it because it's got to go out fast. The key is it's got to go out fast. And now we're saying, oh, geez, we put the money out fast. We created inflation. Our economy is going into a tailspin. We got to increase interest rates because we printed too much money and it went to the wrong places. So we temporarily fixed something in order to exacerbate the problem down the road, which is we've been doing this. The same game plan we've been playing for 20 years now, right? Kick the can down the road. Well, guess what? There's no more road left. The can's going to fall down. You won't be able to kick it anymore. You have to jump off the cliff to find the can.
Oh, man.
Listen, interest rates are going to go up, and then they're going to come back down.
Yeah, what goes up must
So
come back down.
I
That's
can't
what
tell you.
telling
I'm
my
not going to tell you
clients.
about the stock market. I'm going to tell you about the real estate market. Okay.
Tell me.
We're going to reach a more normalized level in the real estate market where things are going to make more sense because they don't really make a ton of sense right now.
Right.
The amount of disposable income that a Canadian needs in order to service the debt on their home is too much.
Right.
They don't have it.
Yeah.
Inflation is high. Inflation will come down. I do not think inflation is going to come down because of the other thing is we're all now forgetting that interest rate increases take time to affect the marketplace.
Which is what you said about inflation coming in. You said when they're printing this money off a year and a half ago, you're like, it's going to take time for it to come in. And older episodes, you were saying all of this.
Right.
It's the same reverse fact.
Right. So the same thing, pendulum's going to swing. It's going to swing too far in the other direction. We're going to have to bring it right back again. It's going to be like, listen, this is going to be a little bit tough, but it's going to be healthy.
Yeah.
We're going to see, I think we're going to see, 20 20% drop in real estate prices?
It's like when my
25? I don't know. Depends on how and when the Bank of Canada determines that we've seen enough.
right.
And make no mistake that drop in real estate prices is going to put people underwater. It's going to affect every single part of the Canadian economy. And when we reach that point, it's going to look like it can't stop dropping.
Right.
But that'll be a point of some health in the economy.
Yeah.
Right? And we'll drop interest rates and people will start coming back in. Right? People still are going to want to live somewhere.
Mm-hmm.
At a certain point in this cycle, the Bank of Canada, like I said, will step in and they'll reduce interest rates and they'll become accommodative. And people will come back into the marketplace. Right now, we're still in this place of like, oh my God, what's going on? Interest rates are going up. Prices have stabilized, right?
Mm-hmm.
That sales to new listings ratio is still in a relatively, like even at 45% for Toronto, is still in like the middle of the kind of buyer-seller equilibrium range,
Mm-hmm.
right? So we're not there yet. Last year we saw real estate prices went up 20%,
Right. Yeah.
right?
That's
Off
crazy.
of what? Off of what economic fundamental did they go up? You want to know what it was? Free money.
Yeah. Free money. Yeah.
Free money and like more money.
Mm-hmm.
Well, now the Bank of Canada and the Federal Reserve and all the central banks from all the G7 countries are saying the brakes are coming in because the only thing scarier than a recession is inflation.
Right.
So it's time to pump the brakes.
Right.
So don't try to swing for the fences right now. How about that?
Mm-hmm.
There's my investment advice.
Yeah.
Make sure if you're putting your money somewhere, you're getting adequately rewarded for the risk you're about to take.
Mm-hmm.
Because more risk is coming into the market. Before, you weren't really getting paid for the risk you were taking.
Mm-hmm.
Because too many people were trying to park money places. So you were it's again, supply and demand, right?
Yeah.
If too many people are chasing a yield, then it distorts the amount of return they're going to receive for the amount of risk that they're taking.
Right. And I would say don't take high risk for inadequate returns, which is exactly what your bank is going to want you to do. Too. Parking money there, right?
I mean, your bank just doesn't give you any return.
Yeah,
Right?
yeah.
There's no risk, like unless there's a
mutual
run on
funds,
the
right?
bank. Yeah, oh yeah. A mutual fund or an ETF, right? Like
Yeah,
you're
yeah.
taking risk, right? Your bank's not risky. Like putting
Yeah.
money in a GIC at your
GIC,
bank is not risky, right? It's insured by the federal government up to $250,000. It's,
But what are you getting there? 1.5%?
there's not a chance you're getting 1.5%.
Yeah. Well, yeah, exactly.
Yeah. 1.5%, you could sign people up all day long.
Yeah.
Which you'll start seeing. Like
Yeah.
GIC rates will increase.
Right.
Banks will want to stabilize. They may start offloading loans into this will happen as we come back out. Right now, you got to understand what we're hearing from the Bank of Canada is the economy is on fire, right? What I'm telling you about is what we're going to talk about in the next 6 months,
Right.
right? So that I can sit here 6 months from now and say, like, can we replay that podcast from 6 months ago?
That is our favorite thing to say.
It is.
I know. And it's just like, so I would say just like batten down the hatches right now.
Mm.
Slow down your spending.
Yeah. Grab a
Right?
blanket. Make some hot cocoa.
Yeah, stay in and have
Just
dinner.
chill.
Don't
Yeah,
go out
yeah.
as much,
Yeah.
right?
Yeah.
Make sure you got some reserves
Yeah.
to weather this.
I like
So you
that.
don't have to be forced to sell something that you don't want to sell.
Yeah. No,
Right?
100%.
And when we come out on the other end of it, you'll have a little bit of capital. You'll be able to take advantage of some opportunities, which is why, like, we've been talking for the last little while, refinance when the value of your property is high.
Mm-hmm.
Park the money. Don't even use it. Keep it on a line of credit. Hold it because opportunities will come. They have not been here so far.
Right. Yeah.
Oh man, the real estate agents that like send us business and like we work with, some of them, not all of them, but some of them are going to be like, ooh, why is he saying that? My buyers don't want to buy now.
Yeah.
Listen, it's unbiased advice.
Yeah.
I hope we see something turn around. Like, I hope that some positivity can be injected into this, like the war in the Ukraine stopping, or inflation numbers being tamed. I really sincerely do. I just don't see. I don't see the probability being in our favor.
And this is another good point too, because I'm reading through some of these emails that we've been sent, and I'm not going to read this one, but we're going to start seeing a really good opportunity, and we are already seeing a really good opportunity for. I've had the last year, 6 months, a year has just been conversations with bummed out buyers who get outbidded, and who are in there with 20 other people, right? And we're gonna start seeing really good opportunities for buyers, first time home buyers, stuff like that.
People bought Nortel at $128,
right?
And then like a little while later it was $4, and then it was $0.
Right.
So like, trust me, it's no fun. A recessionary cycle is no fun.
Right? No. I'm not saying it's fun.
The buyers, the bummed out buyers, are gone.
Yeah.
They're not bummed out. You know who's bummed out?
Right.
The people that are trying to refinance their home to pay off high interest rate loans, and they find out that the value, even that's on their MPAC statement, on their most recent valuation for their home, is no longer supported by whoever is deciding to lend them money.
Right.
Because just like, one day the house was valued at $1 million, and today they know they could probably sell it for 800. Not today, I'm saying like in the future after a drop, they know they could sell it for 800. The lenders become even more cautious and forward looking.
Yeah.
This pendulum swinging, this exuberance that exists in a lending market when it looks like the runway is infinite and property values will continue to increase. When that comes away, it doesn't go to a neutral stance. It doesn't go to a stance of fairness where, okay, it's going to trade at 800. We'll value it at 800. It goes to a defensive stance. And that value then becomes 700 on the lending profile.
Right.
And underwriting guidelines tighten.
Right.
And we're going to see stress test requirements increase because interest rates are increasing. We're going to see, listen, you do mortgages all day long, right? You can see there are banks when we'll see a deal come to us. Borrower will call. What's your best rate? Okay, it's, today, what is it? Around 4%. If you've got 20% to put down or you're refinancing to 80%, it's 4%.
On a fixed rate, yeah.
Fixed rate. And the buyer says, okay, or the refinancer says, okay, listen, I think I can do better at my bank. And they go off to their bank. And their bank ends up giving them more, not maybe their interest rate's the same, but more money than what we predicted that they could get. And they require less paperwork. So maybe usually this person would have been required to provide a tax return. We would have thought through our lenders, that they needed a notice of assessment. And they'll call us up and say, you know what? I went to my local branch and I just gave them a job letter and they said, no problem. And they did my deal. Because the banks, again, they have many tools with which to kind of pull in that business. And when it's an exuberant environment and values look like they're forever increasing, their priority is get the money out the door. This is safe and easy. Rates are continuing to go up. Property values are continuing to go up. Let's get the money out the door. Buyers are safe. Values are going up. All of that goes away. And the way they lend from a value of property perspective goes from being, really high lofty values, which we're surprised. We're like, oh my God, this value came in higher than we thought it did.
Yeah.
To depressed values and defensive values where we're fighting with appraisals. Come on, this appraisal, we know this property's going to sell for 800. Appraisal's got to be at least at 800 and you're fighting to get 800. Same thing for underwriting rules, right? Where you once could have gotten away with walking into your local bank and saying hey, come on, help me out. Here's a job letter. And the bank says, no problem. That's going to fall away and it's going to turn into, we need a ton of documentation.
Yeah.
It's going to tighten up, right? That tightening is what we haven't seen yet. So don't get caught needing money in that tightening period. Borrow the money in advance of being there, right? Put yourself in a powerful position when you're negotiating with your bank.
Get ahead of the 8 ball.
Right.
I've said it to so many clients over the last little while that if you really are worried about housing prices going down and interest rates going up, like it makes the most sense to get as much money as you can right now.
Right.
It just makes sense. Like,
Yeah.
because if you're looking into this in the future and all of a sudden the prices are down, interest rates are up, and you're trying to get access to it, what are your options?
It's like there's another old little pearl of wisdom. You want it?
I love
Okay.
a good pearl of wisdom. Bring it on.
All right. If you borrow a little bit of money from a bank, it's your problem. If you borrow a whole lot of money from a bank, it's their problem.
I like that. I like that. Hey guys, my name's Martin. I want to pull more money out of my house for renos, but I think I'm in a good situation with my current mortgage. Heard that a lot lately, and don't want to mess with that. I have secured a low rate 2 years ago, and don't want to refinance and lose that rate. I've heard about home equity loans, but I know they are pretty pricey, especially with rates rising right now. Do you think it's too expensive to consider? Are there other options out there?
The home equity loan market is going to explode
Yeah. 100%.
in this next cycle.
100%.
So if you are looking to invest in a MIC, invest in ours and do it right away. Because I'm going to tell you something. The caliber of borrowers that we're going to be able to attract in our fund and still maintain a really nice yield for our investors when there's no other yield out there, right? It's going to be like nothing we've seen in the last little while. So like a guy like Martin, okay? Let's say he got the best 5-year fixed rate 2 years ago.
167.
Yeah, 1.5. Never
Yeah.
mind. Like I saw 1.5 floating around. Okay? So say he got 1.5% on a 5-year fixed rate. He's got 3 years left to run on that 1.5. He could break his mortgage now. Let's make up numbers for Martin. Okay.
Yeah, okay.
So Martin has $1 million house with a $500,000 mortgage at 1.5%.
I was just thinking that.
Okay, great.
Okay, go on.
That's easy numbers, right? So he's got a $1 million mortgage. Oh, sorry, $1 million house, $500,000 mortgage, 1.5%.
Okay.
He needs to do renovations. How much money does he need? 100 grand?
100 grand, 200 grand maybe.
200? Don't go 200 because I probably wouldn't. We as Cannect probably wouldn't lend 200.
Right.
Right? We got to be, again, the pendulum is swinging, right? We're going to be conservative on that value. So $1 million today, we got to discount that a little bit because we know real estate prices are coming off.
Right.
No offense, Martin. This is for Martin's good and for our good.
Yeah.
Because if we give Martin too much money and if prices don't stabilize back to $1 million, so let's say we give Martin your 200, which is why you don't underwrite mortgages. Okay. Let's say we give Martin $200,000.
Yeah.
So we take his total debt now up to $700,000,
Right.
which we are not doing for the record. Okay.
I
We're not going to do this.
I didn't say we were going to get
No,
it to
I know.
him.
Well,
just said he wanted-
I'm closer to 100 grand. What I'm
Okay.
willing to approve right now for Martin's about 100 grand.
Okay.
Especially after seeing the market drop this much today.
Yeah.
Hey, $100 grand is also kind of making me a little nervous.
Yeah.
Okay?
Maybe closer to 50.
No, 100 grand. 100 grand's fine.
Okay.
Especially considering Martin probably has great credit and great income because he qualified for the 1.5.
Okay.
Okay.
Yep.
Subject to great credit and great income, Martin can have 100 grand. I'll price it right now for you. 6.5% with a 2-point fee for a year. We have a look at the end of the year. If things have stabilized, we'll drop the rate for him. Okay. If values are kind of holding where they are, might even give him a little more money. Okay. But we got to feel things out over the next year. But 6.5% on that 100 is way cheaper than Martin refinancing $500,000 in debt from 1.5 to 4%.
Yeah.
Because that delta is
3.99.
3.5%
Right.
on $600,000, not just the $500,000. He's going to increase just the expense on the 500 grand by $7,000. 3.5 times 500, right? Not to mention he's going to have legal fees. He's going to have to break that existing mortgage, which is already a really good mortgage. So 3 months interest on the 500, there's another $4,500. Like the costs will add up when he looks to do this.
Right.
People like Martin, number one, should be careful if they're going to borrow money in this environment.
Right.
Right. Like again, you would advise them the same thing.
Martin will thank us later.
But it'll be cheaper to do the renos too. Like, I don't know if you noticed, right? Like every cost went up. Everybody wanted to renovate. So those costs, as fewer people want to renovate, will go down. It's going to be cheaper to redo your basement in a recession than it was last year.
Yeah.
Okay.
100%.
So, but the home equity loan market is going to be so competitive because the weighted average cost of capital will benefit the consumer. It will benefit the consumer to borrow money in second position at a good rate. Good borrowers borrowing at good rates. I'm talking like 5, 6, 7%, instead of refinancing the entirety of their first mortgage in order to get the money that they need and pay more interest on all of it.
Yeah.
Match the maturity of the existing first mortgage and provide them with a good exit at the end. What you don't want to do is you don't want to give Martin 200 grand. This is what I was saying. You don't want to give him 200 grand on top of his 500. And then 3 years from now, we're still in a recessionary period. Property values has come off. Martin's house is worth 700 grand now.
Right.
Okay.
Yeah. I wouldn't do that.
There's no escape.
I wouldn't do that to
Right?
Martin.
Right. So what should Martin do? Obviously, he should do a home equity loan. Obviously, he should probably figure out, like, is it going to add a significant amount of value? You know what I would love? If Martin was spending 100 grand to add a basement apartment.
Mm-hmm.
Then it would be a slam dunk,
Yeah.
right? Don't add a home theater in this environment, right? Maybe not a home theater, Martin.
I like speakers. But interesting thing that you said that I kind of wanted to point out is, you had mentioned that home equity loans are going to get competitive, but they haven't yet. Everyone else is raising their rates, in relation to rates going up, but we have not, right? Like, we're passing along the savings to the borrower still.
We're focused more on risk than we are on return. So if you're investing with Cannect, I mean, our rate went up maybe on average, we might be up a half point from where we were last year because of the way interest rates have moved. But I mean, okay, so the way the MIC is built, because we don't pay anybody to bring investors to us, we're not forced to deploy capital, right? We can sit on money. And we're also not forced to have a target yield. Like a lot of our peers in the lending space pay to bring money in the door, right? So like if they want $100 of an investor capital, they may pay $4 or $5 to get it in the door, 4 to 5% to get in the door.
Right.
And then they have to pay mortgage brokers to source mortgages for them. Another $2 to $5. So the $100 that they get from the investor kind of ends up being $90 when they're lending it out. And they have to offer a good yield to their investors. So they have to find risky borrowers. Cannect doesn't pay mortgage brokers, and we don't pay people to bring us money. So we don't pay for deals and we don't pay for investors. And what that allows us to do is allows us to transfer the return that we're receiving for the risk we're placing the capital at directly to our investor.
Right.
And in an environment like what we're seeing right now, we don't have to chase risk. We can provide a good solid yield. And when everyone else is trying to get to a return number, I don't care. Mm-hmm. I don't care about the return number. Mm-hmm. You know what I care about? Making sure every dollar of capital in our fund is safe.
Right.
That's my concern.
Yeah, 100%.
And it will always be the overarching mandate of Cannect.
Mm-hmm. Mm-hmm. Bottom line for Martin, if he wants good advice, and he wants,
100 grand.
100 grand, fine.
100 grand. It's not 200.
100 grand, and he wants some good advice. Head over to connect.ca, fill out the application, get a quote instantly, and one of our salaried agents will be in touch with you right away.
Yeah, I mean, it's important to say, like, we have all this automation, right? So you can go to the website, you can like immediately download an approval. Literally, depending on how quickly you can enter in your information, you get the approval in like 30 seconds.
I'm pretty quick on my phone, so hopefully Martin is too.
Yeah. So, but it still comes with a phone conversation. Mm-hmm. It still comes with, what do you need the money for? What is the timeline? Like, you're still going to get the sound, unbiased mortgage advice that has made Cannect into the company that it is. Mm-hmm. We are not just handing money over because you have equity in your home.
Yeah.
Right? Again, I'll say this again. Litmus test for borrowing money from Cannect is, what are we fixing? Yeah. How are we getting you to lower cost capital? What is it thing that we're fixing? Typically, in the market that we've seen, where interest rates on first mortgages were so low, we needed to fix something to help somebody get a low interest rate. We needed to fix income, we needed to fix credit, or we needed to fix real estate. What we're going to see now, which is why I believe it's such a great opportunity for the home equity loan marketplace, is we're going to see people that we don't have to fix anything for. The only thing we have to fix is time. The only thing we have to do is help them maintain their low cost of borrowing, not take them to low cost borrowing, right? Keep your 1.5% 5-year fixed rate, borrow an amount of money that you require to do whatever it is that you need to do and to take you to the maturity of that existing 5-year fixed rate mortgage so that you don't have to break it. Because I guarantee you, the banks are going to be all over people to break those first mortgages.
Oh, yeah, for
Right?
sure.
You got a 1.5% 5-year fixed rate with a bank. Hey, why don't you borrow some more money?
Mm-hmm.
Why don't we refinance this into a brand new, and they won't even say the rate, brand new low monthly payment.
Yeah.
You know interest rates are high when people start talking about what the payment is.
Yeah.
Okay? And that's another stage in this cycle.
Yeah.
I've been doing this now for over 20 years, which is crazy. I'll tell you something else. In over 20 years, we have not felt any pain, right? Like we saw a couple little blips on the radar.
Mm-hmm.
I hope that this is just a blip on the radar.
Mm-hmm.
I think it might be a little more than a blip on the radar, though.
Yeah.